people aren't prepared right now for if things go right. If they actually,
I would 100%, it's a very good statement. Like we're all thinking we're on the third year if it's going to be a recession.
Yeah.
The longest, ongoing call for a recession ever, right? Yeah. That's a good statement. Yeah. Ladies and gentlemen, Tim Dyer is in the house. It's nice because we get to do this face-to-face, not over Zoom. We're local.
That's right.
So Tim and I, funny story is how do we meet Tim is through our kids. So now I start telling that story. It's not just, I've really cut out of the way. It's not just meeting people through work or real estate. And Tim is not in the real estate business. So, but we met through our kids and we hit it off and they go to school together. They did go to school together. They're going to go to school together. So Tim, welcome.
Now we just attend all the birthday parties for all the kids that we met together.
Exactly. Tim, welcome to the show.
Good to be here.
Thanks for stopping by. Glad we're in face-to-face. So just for our audience, they're going to find out quickly what you do. Can you tell a little about what you do, your background, how you got here?
Yeah,
all that fun stuff.
Well, I'm what you call a wealth manager, and I can dig in on what that is here. But I've got a little office down in Bird Rock with a creatively named company called Dyer Wealth Management.
Whoa, how'd you go with that?
I had actually, funny backstory, when I left, I was working for some major Wall Street firms. And then, the sort of logical transition is to set up your own practice after a while. But I remember I hired a big marketing team to come up with this, or consulting group to come up with this big, and they had all these different things. And it was just so silly. And I'm like, look, I don't have time. We got to get down to business. Dyer Wealth Management. Let's move on to the next thing.
I love it.
It turned out right because my name's on the door, and everything kind of flows through me in a way. So it's nice to have that. Not only the brand, but hey, look, I stand behind my name. If it screws up, it's on me. So from the Simpson team.
Yeah. How long you been in the biz?
I started the business in 1998, so my entire career has actually been in what you'd call financial services. And so I started working out of school I went to school in Boston, but when I came to California, I started working at a company called Prudential Securities. So it was actually the investment and trading arm of the Prudential Insurance Company. People are like, oh, you sold insurance? No. But I enjoyed my time there, learned a lot, got trained, back and forth to New York and a lot of those things. We were coming into .com then, so I was on the front lines for a lot of the heyday and the excess that went around with that. I remember companies going public with no revenue, no earnings, and just worth billions of dollars. And then, what was it, puppets.com or all these different things.
That's so funny.
And so, there was a few things that happened along the way that kind of changed the trajectory. But I moved over sold my practice to a company called Payne Weber, which
I've heard of that.
They got acquired by a Swiss bank, UBS.
Okay.
And so that, that's kind of the transition there. But I was there for a few years, probably 5 or 6 years. And then 2008 hit, which was the great financial collapse. Depends on what industry you're in, what you call it. For us, financial collapse.
Is that hard on you guys?
Yeah, it was. It was because when the floor fell out, nobody
freaking out.
Yeah, and even experienced people. I'd now been in the business for 10 plus years. I'd been through .com and a few other tumultuous markets, but even people that had 20, 30 years, like they were sweating, and it's like when you see the flight attendant pale, the little turbulence, like this is this is not good. But we got through that. Anyways, it was about 2008. I left what you'd call the traditional corporate world. In our side of the business, we call it the wirehouses, big brokerage firms, because they used to have to wire instructions back to New York for trade. So anyways, that's where that little nickname comes from. And I actually joined a colleague of mine that had left Morgan Stanley. So I was leaving UBS, he left Morgan Stanley. We kind of met in the middle and created a little investment company. And that was chugging along fine. Our paths kind of split naturally just because he was doing a little bit more on the planning side and I was doing a little bit more of the portfolio management stuff. So, kind of fast forward today, I did join another company called Sage Capital. And so the thing about Sage is they were managing, or still are, a large institutional account, one of the Indian casinos here in town. And they had kind of a lot of business risk because when you think about, I call it the upside down triangle, right? It was this one massive, $1 billion type account, but not a lot around it, right? So I kind of came in, I was working with a lot of entrepreneurs, high net worth executives, that type of thing. So we kind of filled in those corners and give it some stability. Well, with the success of both of those business units, they started to grow into their own type entities. And, the type of things that you do for $1 billion, family office, if you will, is a lot different than you do for somebody with 2 or 3 million. They just want, hey, give me the one piece. Are we doing okay?
Yeah.
The other people got investment committees and, monthly meetings. So I said, hey, this is kind of nuts. Why don't we just, separate the entities? And so Dyer Wealth Management was kind of created out of that. So,
okay, cool. Okay. It's a cool story.
Yeah. And, right now we work with about 70 families. To put it in context, when I was at UBS, probably had 700. It was a different, you're.
They're getting way different experience.
They are.
Yeah.
They are.
It's like a lot of personal touch, reach out, sit down planning, like an actual, That's one thing I was going to get into too, because I think a lot of the, when you think about when somebody says you're a financial planner or you're a wealth manager, this, everybody's like, kind of, what the hell is that? So we should just ask the question, what the hell is this? Like, what is it? Like, because there is a lot. You see people on Wall Street, I manage money. Yeah. I'm a day trader. I'm this. So I think people are just lump it all together when it's really not supposed to be lumped together, right? Right.
And I kind of simplify it, and everything falls under the umbrella of financial services, if you will. Yep. But I think the way to, you bring up a good point, right? And people are like, well, what do you really do? What is a wealth manager? What is this and that? I think of it, again, going back to my triangle example, but if you think of a triangle with 3 levels, the first level would be what I call the product level. Those are companies like Fidelity and Vanguard and E-Trade or whatever it might be. They have products. You can go to them and get products cheaply. They have a lot of services that kind of go with that. But you're doing a lot of driving on your own, right? You go up the next rung of the ladder, you kind of get into that, what I'd call the financial advisor space. And that's where you might find people again at Merrill Lynch or UBS or something like that. And, I worked there. I mean, it's a lot more focused on the investment side of things, right? There's estate planning and there's some things, especially as you go up higher net worth, there's a few more services there. But when you go there and you have a meeting with your financial advisor, a lot of times they're pulling out the portfolio and saying, here's what's happening. Here's some changes that we need to make. The wealth management space, that kind of triangle at the top, I'd say about 4% of all the hundreds of thousands of financial advisors kind of fall into that demographic, if you will.
Are you at that level? I guess I think for me is at that level, I think a lot of people get in here. It's oh, we're going to put you in this stock or this, I don't know, is it a ETF?
Sure. Yeah.
This fund. Yeah. Whatever, I'm not adverse to all this stuff, but mutual funds, stuff like that. But are you guys at your level when you're at Morgan Stanley, are you picking that? Or is this you got to, this is what we recommend. This is what you should be pushing. Cause I know with you now, this is, you're doing it. They're leaning on I guess my point is a lot of people are leaning more on your research, what your thought process is, not hey, well, Merrill Lynch says we should all do this, or I don't know if that's how it works. I'm just wondering.
Yeah. Well, there's 2 ways to unpack that. And the first thing I'd say is the financial advisors that fall in that middle rung, some of them do their own sort of stock picking, if you will. That was far more prevalent when I started in the business in the 90s. Now a lot of this stuff has sort of become a little bit more packaged, right? Packaged mutual fund products, packaged ETFs. For clarification too, a lot of times people hear index funds. Yeah. Index funds are ETFs, right?
Okay.
Exchange traded funds. Okay. But they're usually tracking an index like the S&P. So all index funds are ETFs. But not all index or ETFs are index funds. You could have one that's, tracking semiconductor stocks or something. So it's an ETF, but it's not necessarily tracking an index. But they kind of get used interchangeably, like clean.
Can you explain exactly what an ETF is?
Yeah, and
or like, just breaking it down. Because I think people hear with this, because this thing's gone viral because the Bitcoin ETF and it's all over the news.
Recent,
so everybody's kind of like, what exactly is an ETF? I don't think people really understand exactly what it is. I don't even really know.
If you think back, in the old days, you bought stocks and bonds, right?
Okay.
So what happened was I think it was MIT put together the first mutual fund. The first mutual fund is really just a basket of stocks or a basket of bonds or a basket of a combination, whatever the investment discipline is, right?
Okay.
So a mutual fund is that basket, and there's millions of different versions of that, flavors, but you get the concept, right? It's a basket or collection of investments. The value, you think of it like a pie, right? The value is the sum total of all the parts divided by the amount of shares. So if there was, let's just say there was $10 million in a mutual fund. It's more like 10 billion, but $10 million in a mutual fund. And you came in and you bought $10 million of that mutual fund. They would just issue additional shares of the mutual fund. Okay. So now there'd be, 20,000. Okay. Yeah. And they would buy, what was in there. So it just expands based on, the shares.
Okay, I see what you're saying. Okay.
So now the price moves up and down, but they value it at the market closes at 1 o'clock here Pacific, and they value, the total shares by the price, and that gets the value. They call that the net asset value. Now I go through this exercise because mutual funds, they trade based on what their closing price is.
All right. Okay.
Now, a stock, when the market's open, you buy and sell it.
Yeah.
Somebody buys in the morning, maybe it was up, and then in the afternoon, maybe it's down, whatever, right?
Yeah.
So an ETF sort of combines those two things because it's a basket or a collection of securities, but it trades during the day like a stock, right?
That's interesting.
Yeah, and so you can
it can be more volatile.
It can be,
okay.
Yeah. Now they're diversified. Some of them are aggressive. They're buying Bitcoin.
I think I was just thinking about Kathy Wood. Obviously, she's heavy in tech. That thing kind of.
Sure.
But
ARC, right?
When when it's good, it's booming. When it's bad, she was down like 70-75% just because tech was down. You know what I mean?
Yeah, and so the thing about ETFs is traditionally there isn't a lot of stock picking that goes into them.
Okay.
It's usually like a discipline that's maybe she's buying the top 50 stocks with the highest momentum, and they might rebalance or make some changes, but it's not like she's sitting there going, I want to buy Coke and sell Pepsi.
Yeah.
So ETFs a lot of times even though they're actively traded, they're not always necessarily actively managed when you look underneath the hood. Does that make sense?
Yeah, I totally get it. Yeah.
So, just kind of take another step. I would say that mutual funds are essentially kind of disappearing. They're not, so many people are familiar with them, buy a mutual fund, but as people get a little bit more educated, the money is coming out of mutual funds and it's going into ETFs.
Okay.
Because they're easier to trade, they're cost effective, they're efficient, they're highly liquid.
So the fees are much lower for the consumer, or
they can be, yeah. Okay. Because again, a lot of times people and Vanguard made this popular with John Bogle, right, where they just track the S&P 500. You get the computers to sort of line up with what the 500 stocks are, what the percent weightings are. It doesn't take that much work, and you just keep that overhead low. It's a very, very low cost way. I'll give you an example. When I started in the business, mutual funds used to have internal expenses, meaning the cost for the manager in New York to kind of overlook this stuff, was 2-3%, right?
Wow.
That's come down a little bit. Then ETFs came out, index funds. Mutual funds are kind of at that 1% range, roughly. But ETFs might be at a quarter, 10 basis points.
Yeah, I saw that. So it's funny. The battle of the Bitcoins were we're at 25 basis points, 24 basis points, 20. It's okay.
Yeah, no, they're chasing spot, right? Yeah. Which is basically they're tracking the absolute price of the coin, or the digital currency. But the only thing those companies can really do is cut their internal expense and market more. So they've got to find that balance, right? To get out there and say, hey, we're reputable and this and that. But they're really kind of tracking the same thing,
No, for sure.
So,
they're winning by, do you go to, if it's, BlackRock or, you going to Fidelity, it's who you're comfortable with. If you're at Fidelity, you're probably going to stay with Fidelity, right?
Sure.
Okay. So on your website, it says wealth manager specializing in retirement planning and investment management. We help clients succeed financially by removing the burden of managing their own wealth alone. So I want to unpack that.
Was that the consultants that came up with that? I don't know.
I like it. I like it.
Yeah.
So you have a Series 65.
Yeah.
Which I don't know what the hell that is.
I'll explain that.
So if you can explain what that is, and then I want to go back to your, I don't know if it's your tagline or something, because I want to talk about that. Because most of the people here are real estate, right?
Yeah.
So a lot of people, when we think about real estate, is you're saving up money, you're deploying it into real estate, and you're looking at maybe an equity,
right.
You're looking at cash flow, you're looking at depreciation, the tax savings, and then obviously they can exchange out of it tax-free or whatever. But obviously if that person doesn't manage it, they got to go hire a third party, right?
Yeah.
So you're dealing with somebody, it's like, maybe they have real estate, but they're also like, hey, I need to put money into different buckets.
Sure.
And so that's what I want to get into.
Yeah.
Because I think a lot of people in real estate are just so focused on real estate. I like to diverse more. But we'll go into that. But tell me what a Series 65 is, because I have no idea what it is.
Come on, your view of diversification is like 100 homes instead of like one in one neighborhood. So I know how that was. All right, so a couple things. I'll just talk about the licensing. So you guys have real estate licenses and commercial and this and that. In the financial services world, there's two sides, right? The brokerage side of the world, the wirehouse side of the world, those guys have what's called, or those financial advisors have a Series 7.
I heard of that. Okay.
A Series 7 is it's a tough exam, and that is essentially giving you the right to earn a commission, for transactions.
Gotcha.
That's what that license allows you to do, right?
That's a good way. I never heard that explained like that.
Yeah, and slightly more nuanced, but it's basically you're licensed to sell, just like in real estate. You sell
the test is really about ethics and just like us.
Well, there are some tests around that,
okay.
which you need to get with it. There is an ethics exam and things like that, but that's really about like securities, how they operate, suitability, some things like that. On the other side of the ledger, if you've got financial advisors over here and you've got independent side of things, that's where you have what's called a Series 65.
Okay.
And a Series 65 is basically saying, I now have a license to charge for advice. That's all that is. You could get that and you could give advice on, what color you think the sky's going to be tomorrow, right? But there used to be two exams. They kind of got commingled into one. Like the 63 was the ethics exam and 65 was the Investment Advisor Act. But that, look, in English, it's basically the ability to be able to collect fees for advice, right? Now, I had a Series 7, and when I worked at UBS, if somebody bought 100 shares of, Qualcomm stock, there'd be a little commission on that or something like that. I also had a 65, so I could charge for advice. But I didn't, the industry has shifted so much now. It comes down to a lot of planning along with investment management, which is kind of along with the tagline you were talking about.
Yeah, it does.
And so it digs even deeper here, but I think this is important. On the independent side, the advisors in that space, for the most part, are what we call fiduciaries. Right?
Okay.
So you're operating under a fiduciary standard as a Series 65 license. Now, what does fiduciary mean, right? Okay. Well, it's you've heard the term. You have a legal obligation to put your client's interests first. Now, look, when I was a Series 7 financial advisor, or stockbroker, as they used to call them, I would do the same thing. I wouldn't wake up in the morning and say, geez, how can I, do bad things, right? Do harm. You're like, hey, how can we make money for our clients and this and that? But there's a really important distinction between the two, because on one side, you're sort of caught in the middle between two masters. And I'll give you an example. If I'm working at a major Wall Street firm, I'm employed by this firm, and I've got clients that, I work with, right? The clients are paying me, commissions and whatnot, and the firm they're the ones writing on my paycheck, right? So you're sort of beholden to two masters, right?
Oh, gotcha.
And again, I'm not it's a traditional way. I mean, it's sort of the old way, but it does pose conflicts of interest, And I'll tell you a story. This changed the trajectory of my career. When I was I told you when I started the business, I went through .com, right? So I was building a business, a practice with clients. We went through that. Now my practice wasn't that big then. So like I took a step back, but you know, it wasn't so big that it like couldn't be rebuilt. You know what I mean? But I remember thinking like, geez, if that happens again, I need to have some protection in place. So I started to learn a lot about like risk management and, you know, trading and hedging and kind of things like that, right? You fast forward to 2008 and I was what we call running discretionary portfolios. And what that means is, you know, clients, we'd talk, we'd set up the investment policy statement. Hey, do we want this money to grow? Do we want it to pay monthly checks? You know, those types of things. But then I would make the trades. I wouldn't call them up, again, use the previous example. I would say, hey, Kenny, I think we need to sell Coke and buy Pepsi. I would just do it, right? Okay. And it was all under the mandate of kind of what we set up. I wouldn't be off buying, you know, crazy things. It was all, you know. But in 2008, see, people forget the stock market dropped 37% in 2008. But its peak to trough actually started in, what was it, June or July of 2007. So it started dropping. It continued to drop through 08. And then it continued, March 9th of 09 was actually the bottom, right? So we look at that total drawdown, it was 57%. Wow. Right? So $1 million is what, 430,000 if it was just an
freaking out.
People were freaking out. Oh, yeah. But because of that risk management, you know, I was raising cash. I had some, you know, what we call stop losses in there that was raising cash. And I remember I got a call from the regional manager at the time. He's up in LA. Dyer, I want you to come on up. And I thought, okay. Now this was the beginning of 08. So like all hell hadn't broken. Things weren't good. So my portfolio was like maybe, I don't know, let's call it 20% in cash, right? Okay. And 80% in the stocks that I liked. But it was going the other direction. Like stocks were getting sold and more cash was being built up as the risk levels went up. So I get up there and I go, okay, this is it. This is going to be my big break. This guy's gonna say, Tim, you know, you've been in the business a while now. You've got a good practice. You got good clients. They're loyal clients. They love you. I mean, hey, these new guys that are coming in, you know, we'll go out them and they'll do business development. And you can come in and you know, help bring in the business and then just service it. You know, run the money. This, you know. 2-hour drive up there, you know, with probably forward traffic. I get up there ready for my big break and I'm sitting in this conference room. You know, the guy's about 20 feet away from me and he goes, Dyer, you're up to 25% cash in your stock accounts. You know, we don't get paid on cash. If you don't get that money invested by the end of the week, we're not paying you your fees. I was like, what?
What?
I mean, here the market is just clearly going down.
You're like, this guy's a genius. Yeah.
I mean, and I'm like, what? That was like, what? And so I called, you know, some of my clients and, you know, and I just said, hey, look, this is the deal, man. Now, back a little side story. Back then, you didn't have a lot of options where you could sort of park cash in an investment. It was like cash. Now you've got ETFs and other things that are pretty conservative that you could sort of, so it kind of looked like a security, even though it was kind of cash equivalent. Anyways, that wasn't an option back then. The client's like, hey, Tim, do whatever you want, you know, do what you think is best. And I go, all right. We packed our bags and it was like, I'm walking out of the building on 8/8 of 08 as like, the thing is burning down, you know? And we got set up and we navigated through that. And you know, again, I really enjoyed my time there. I learned a ton, but this fiduciary side of things is a different angle. Like I literally sit on the same side of the table as my clients. We're talking about what they need and we're looking out into the spectrum of options and say, hey, let's pencil some of these things out, you know? And we make decisions. Here's the thing. You're a real estate guy. You know, your listeners and stuff are real passionate about that stuff. That's great. I'm not going to tell you to sell a multifamily home so that you can buy some S&P 500 because I don't care. Yeah. I want you to do what's right for you, but I've got the tools. You might say, look, we've got 2 young daughters, want to get them to college. All right, well, you can buy a multiplex in this town and do it that way. Or I could set you up with a tax advantage account here. Yeah. Either's fine. Yeah. And I can get paid for that advice, you know? And so I'm seeing more and more too in my practice, which is why this conversation is so interesting is, you know, people that are either heavily real estate, or maybe they've got a new business venture or a future liquidity event. They're building something up. And, I'm not beholden to like, hey, do I manage their stock portfolio? We have the capability of doing that, and we do that well, but we can just deliver good advice that fits for what they're looking for.
Yeah, and that's the thing. Like even in our business, we were on a podcast earlier today, and that's what we were talking about. There's, the loan officer that's new in the business that might work at a bank. Then there's a loan officer that might be a retail loan officer. Then there's a direct lender. Then there's the broker.
Yeah.
And as a broker, depending on where you're at, you really are kind of like with me as like, I like being a broker because I get to build my own business.
Sure.
I use my own tech, this, that. But as you get further in your career, just like you really become more an advisor. You're not a stock picker. You're not this, right?
Right.
So for me, Krystle and I become really advisors to help people, whatever, right? That's what it is. And so I'm not really about the commission. I'm like, if I just give you a good advice, help you out, you're going to use me regardless, right? Maybe you'll go somewhere else, whatever, but you might come back. And I think that's what I was reading here with you. It's, we help clients succeed financially by removing the burden of managing their wealth alone, you know? And that's like with us too, is you're going to go buy real estate, you're going to finance real estate, whatever. You doing it alone is tough. And so a lot of people, and that's what I was going to ask you about with us is, we did this whole thing. We sat down, we're like figuring out our brand and, what problem do we solve? We're like, we solve this and that. She goes, no, that's not the problem. I go, I give people loans. She goes, no, that's not the problem. I go, and then after, she goes, we can't move past the next thing until after this. I was like, how long does it take? As long as it takes. And we're in this room, that front room, the fishbowl we call. It was 2 days. It's 8-hour day and another 8-hour day. And I'm like, this is ridiculous. So within an hour, maybe we came up with, we solved the problem of insecurity.
Yeah.
And so what I tell people is, look, why really people reach out to me, maybe you're why you're managing their wealth and not alone, is we're giving them confidence.
Yep.
They don't do this every day, right? So that's one thing I was going to ask you is, people are coming to you, and that's the thing. The one thing which is funny is we'll say, hey, where's your financial advisor? Well, I haven't talked to him in a while. What? And I think there's the stat, what is it? 80% of financial advisors, they don't talk to their clients, or is that what the number is? I'm making it up, whatever, right? We can Google it. My point is that you're managing a smaller book of business, but you're giving more of the advisor. You're giving more of the service. You're giving them more of the confidence, right? So what is that relationship like for somebody? Like quickly as you can, when they come in the door, they get from you. And if somebody is not getting this or that, what should somebody expect from an advisor? Like if you have so I'm getting to a point where it's like, I know, like for me, if somebody comes to me like, what should I expect from realtor or this or that, I'm going to tell them. And that some realtor might get, that's bullshit, I don't think that. I'm like, well, I'm just being honest, because that's what you should get. Yeah. I'm asking you like, hey, no BS. Like what is somebody should be getting if they're not getting it? Like, why is that? Is it experience? Is it because it's not set up that way? Or is it, look, there's all those, they're just like, I just want to close the deal and make money.
Yeah.
They don't care about the relationship, And we say we're relationships over transactions here. That's the kind of.
Love it.
Yeah.
So I think when we talk about that triangle of advice, right? The products, the financial advisors, and the wealth managers. And by the way, I mean, I've talked about this before, but like, that's not etched in stone. Like I didn't necessarily make it up, but I also didn't so I think if you have your accounts at Vanguard, you're not expecting somebody at a call center to call you up and be like, hey, how are the kids? You need some term insurance or whatever. So that's pretty clear. I think in the middle is where there's a big disconnect. Now, usually when people get to a certain point, maybe in the old days, they thought when I get a certain level of wealth, but it really is when you get to a certain level of complexity, you now have got children, you're moving up the chain at work, the stakes get higher. You're like, hey, I might need somebody to help me this. A lot of times you start in that financial advisor space. Hey, who do you work with? Who's your financial guy? And they say, I got this guy at XYZ company, right? And they go in there and they do get a lot of their questions answered, right? But as I said before, I mean, even in my younger days, I had 700 clients. You know what I mean? Some of the big guys, they have thousands. Now they've got these sort of tiered systems where they've got junior brokers and they've got a army of assistants around. That's fine. But it is very rarely, maybe except for like a few of the top clients, it's very rarely a proactive approach. They come in for a review meeting, maybe they do this, that, and they're almost always putting out fires. And again, I'm not here to knock on that. I worked there for a long time. But there's a big difference. And so, at our firm, we have an entire calendar of things that we're going to tackle. Wow. And it's two-way. It's a two-way approach. Hey, I need this from you. Hey, we need to get on this, and you get to understand.
So the clients so if the client's coming in to work with you, it's also, they have to be willing to be on the same wavelength as you.
Yeah.
Because you don't want to work with somebody. It's like, hey, if you can't give and take here, then I'm not going to be able to produce or do what you need me to do, over here.
That's right.
Yeah,
that's right.
So that's interesting. Okay.
In order for us to do our best work, so you talked about what's the process look like?
You want people involved. You want people to come meet with you. We're trying to, and that's the other thing. It's you said managing their wealth, and for real estate, I'm like, a lot of people are investing in real estate to build wealth.
Yeah.
To build equity, to build cash flow, right? Whether you're whatever it is. So with you, you are helping people build wealth.
Sure. And
to do that, it actually takes time. And you have to pay attention to. So we joke around, like Krystle and I, but I always say on Instagram, it's amazing if everybody just spend 1 hour a week on paying attention to their credit cards or their bills or their money, or just where's your money going? Why isn't it growing? What are you doing with it?
Well, how about this? All right. So we're kind of combining a bunch of different topics here, conversations, but we were talking about the difference, the different tiers, right? If you're working with a financial advisor right now, the first question I ask clients when they come in, one of the first questions is, does your financial advisor review your tax return? And 95% of it, I'd say 99% of it. No. Why would they do that? I've got a CPA for that.
Wow.
I said, okay, well, we'll kind of role play on this here. If you've got a property and you've got a property in California and you want to sell it and you want to buy 2 in Arizona or something, is that going to create a taxable event?
Depends on how you do. Yeah.
Right. Yeah. You could do a 1035 or whatever.
1031, yeah.
Yeah. 1035 is insurance. 1031 is real estate. But it's affecting something on that tax bill. Why would you not have somebody involved or looking at those types of things, right? Now, you have somebody that does tax prep, right, that prepares the return. But see, like the financial advisor, most CPAs, and I'm not knocking CPAs, but they keep score. They say, what happened in 2023 last year? Okay, income. And they're not saying, okay, what if we looked at this over a 5-year window? So if they saved you money in 2023, then they've probably done their job, right? If you haven't had to pay any penalties and whatever, they save you some money. But I would argue, look, there's a lot of big decisions that you make along the way. And instead of picking up dimes in front of a bulldozer, trying to get a little better return on this investment versus that investment, hey, how about we solve your tax bill and save you 30% on a big number? You know what I mean? And when I look at people's tax returns, there's just things that I see that are inefficient, that when you start putting this together, and in the industry we call this holistic approach, right? But you're taking an approach that brings in the tax, it brings in the investments, it brings in the real estate, and says, look, how does all this stuff, does it line up with the values that you have and with the objectives that you want to do? So I think wealth managers, they do that. They bring in that tax component. Now, they might not internally handle every specific issue.
Yeah, of course, yeah.
If I had somebody that had a really complex, real estate thing, I'd probably say, talk to somebody like yourself and get some color on what to do about it. And that's fine. They still look at me, Tim, as their quarterback. They call into me and say, hey, here's what we're thinking, here's what we're doing. And we can work through that. So, and a lot of times people think too, like wealth management, you've got to have $100 million everything. No, it doesn't matter. I mean, I work with clients too, where we might set up a 3-month engagement where they're at that intersection, right? Where maybe they're late 30s or mid 40s. They've got a lot of things converging. They got young kids. We call them Henrys, right? High earners, not rich yet.
That's cool. Okay.
But the stakes are getting higher, and
they got to start investing. Got to start thinking about it. They got to put their money to work. Otherwise, you'll spend it. I always say, if you don't have a plan for your money, you'll have a plan for you. There's a lot of good marketing out there. There's Amazons. You click a button, you'll spend the money. Right? It's it's simple. This is the one thing I think will be fun. We've got real estate and we got wealth management. It's almost like they kind of intersect at some point, right?
Well, I would say real estate and investment management and wealth management is almost an umbrella that covers them.
I was gonna say it's almost like it intersects, brings them together. Okay.
Yeah.
So I want to talk about a couple strategies here, right? Because a lot of people might be going, I'm a high earner and I want to go buy real estate. But sometimes I'm like, maybe it's not the right time. Maybe that's a bad idea, because if you're just buying real estate to buy real estate to get the tax thing, that might not be the best strategy, because you might regret that decision because you're not going to manage it right. It's like, it's the mindset. It's like, that's not really, I don't think that's the way you should be approaching real estate. That's just me, right? Sometimes people, but so somebody's like, they're talking, I'm going to go maybe buy real estate, or I'm going to go give money to somebody like Tim, and I'm talking somebody like you. I'm not talking, I'm talking your level where you're sitting down, you're reviewing, you're really helping them out. What kind of strategies are you doing with your clients right now? Whether it's saving money, first, like the tax strategy, so we can just start there. Like where do you see, like, I'm a corporate guy, I'm W-2, I'm making this, I'm a self-employed guy. Like, if you can kind of give us, what are some of the strategies you're working on that really has done well for your clients? Because you've had a 20-year history, so you kind of know, like, where the, hey, you know what? We used to do that strategy. That's not really the winner now, And I've heard that. People said we were doing that and we kind of went to this. Like, I've heard many conversations. I just listen to clients, because sometimes I just ask you, oh, how's that working? Like, we kind of don't do that strategy more. I'm just talking in general, but I'm asking you to talk more specific about it,
Yeah, I mean, the interesting thing is it's almost like a Plinko chip. It's like everything could sort of bounce a variety of different ways. But when you think about the process, you got to have an initial conversation, right? You call it a discovery meeting, an introductory meeting, but you got to, get the cards on the table, right? And find out where your starting point is.
Are you also looking where their mindset's at too for people?
Totally.
Okay, cool.
Totally.
Okay.
We have questions in our initial meetings, and I've got one this afternoon, and it's like, hey, what's your first experience with money? Oh, I grew up poor. Or, hey, cool. My dad had a business and went bankrupt. I'm afraid of risk. I mean, there's all kinds of things that people's background, right? You could have two people with $1 million. One guy started from zero and made $1 million. One guy had 10 million. He lost 9. He's at 1. They both have $1 million.
That's a good,
Very different experiences with money. So that's a huge part of it.
Okay.
As far as like strategies, tactics, techniques, there's a variety of different things. I mean, first of all, when you talk about W-2, what I've found is that a lot of people, you got to do the basics, right? Get the money in the retirement accounts, take advantage of the company match, allocate your 401k properly, look at your benefits that the company's offering, the insurance.
If you have kids or family life insurance.
Disability, life insurance, those types of things. Some of the basic stuff. But a lot of the, alpha, as we call it, the value that gets added is sort of what you do with that money after tax. You know what I mean?
Yeah.
If you're a business owner, you're kind of having a different conversation.
For sure.
You're moving some things around before, the
Uncle
tax.
Sam gets this. Yeah.
And so you might have somebody that's got a really high net worth, but they're showing a really low income. They're not being nefarious in the tax, but the tax system is two-sided. There's the W-2 people
you just follow it.
And the 10. Yeah. And so it's like, hey, here's the rules of the game, playing.
So there's like the divine, what is it? Pension plan. There's a divine pension. What is it called? The
defined benefit, defined contribution.
There's a 401k for that self-employed, right?
A 401k is a defined contribution plan. But
do you have a lot of self-employed clients then too, or a variety? Okay.
Yeah. A lot of business owners, and I kind of cut my teeth working with Qualcomm executives here in town. And what's interesting is they were W-2, high earners, a lot of stock options and things like that. And making smart decisions with their money after they sort of got it was the way to play that.
Yeah.
There's some other things now that we can do within the company with deferred comp and whatnot. But a lot of those guys have sort of jettisoned off and set up little consulting businesses because they've got such a unique skill in a particular area. And setting up companies and creating some structures around that, really kind of unlocks some different things for them. So, you work with the cards that you're dealt, and there's options. But I think going back to the original point, I think taxes are just, I think they have a bigger role in all these things than people really think about, and there are, people think that you're going to show up on April 14th and be like, hey, wave some magic dust and then just lower my tax bill. It's like, no, that's tax prep. You need to do planning and look at this stuff over,
because sometimes you have a plan, but you can't execute that on maybe for a year or two because you got to set it up. You don't have enough like things like that. But eventually it's like, this is the direction we're going. We're going to start slow and it ramps up. But when you have bigger years, it's set up so you can put that money in there. We're not fire drilled. Hey, it's December 27th. We got to, so that's the other thing is like, why not set up a plan? And then maybe it's not a good year. You're going to put a little bit. When it's a big year, we plow it away and then the money's sitting there and it's like, Tim put it to work, right?
Yeah. So there's that aspect of it, the kind of retirement side of it. With our clients, we set up two distinct strategy sessions, as we call them. We do one right after April, after the tax returns are done, and just sort of look at, okay, did that sort of play out the way we thought? What are things on the horizon, income needs, things that you're looking to do? Maybe it's vacation or start a new business or keep on keeping on, right? Mm-hmm. And then in October, we got pushed back a little bit this year. So I did kind of work pretty deep into the year, but because taxes got pushed back to October.
That's right, yeah.
Because of the flooding here. But usually around after the September, October, when the corporate tax returns get done, we'll meet with clients and then do some kind of year-end planning because we don't want to be running those fire drills that you talk about.
Yeah.
We want to be, spending time with our family and whatnot. But so those are sort of booked, hard and stone strategy sessions. And then things happen along the way. Clients say, hey, something came up. Let's set up a meeting. But clients always know they've got those two pillars where a lot of the stuff we can put on those agenda items. It's not like necessarily a fire we have to put out right away. And because they have a plan to follow, clients are less sort of binary on like, oh, we need to solve this right now. So
we've been working on this for the past few months.
We always want to bring as much value as we possibly can. And our partner, Prime Corporate Services, is all about bringing you a service you can't get anywhere else at a price you can't get anywhere else. Whether you're new to owning a business or owning a property, or you're an experienced property owner or investor, Prime Corporate Services is not only going to help you, but they're going to make the process so much easier. So if you book a call, the first thing they're going to do for you is help you understand what your business structure should look like, your corporate structure, tax planning, estate planning, all of that. Maybe you're saying, I'm brand new to starting a business and all this sounds foreign and complicated. Remember, this company helps new people just getting started every day. They're going to help you form the entity that's best for you and walk you through the process. Before I found this company, we paid thousands of dollars to other attorneys, CPAs, and consultants to try to understand exactly how we need to be structured to be as protected as possible. We've also gone the other route and used online platforms to form entities which unnecessarily put us at risk. You guys, you don't have to do that with this company. They'll do all of these things for you at a reasonable price, so you never have to think about saving money at the expense of exposing yourself to liability. We've searched high and low, and you will not find this much value anywhere else. All you have to do is schedule a free call today. Just go to primecorporateservices.info/GITCG. Once again, that's primecorporateservices.info/GITCG. We'll also leave the info for you in the show notes.
Where's your head at right now with the market? The stock market's really run. Like, I think longer than most people thought.
Yeah. Well,
right?
20 years longer than people thought.
Yeah. So
some of the norms have been broken, and with it,
it starts making people uncomfortable. I listen to like a lot of, snippets on CNBC, just hearing people, a lot of more people are heavier in cash.
Yeah.
It's opportunities, but then they're like, man, I got in cash maybe too early and I lost opportunities.
Yeah.
Obviously, are we going to have a slowdown, recession, inflation coming down, things like that? It's been pretty easy for money to just put money in a T-bill or something and make a 5%, like that. So where's your clients, where's your head at? What's your 2024, not like hey, this is what I think is going to happen.
Outlook,
Yeah. Or just kind of like where, a client comes in and says, hey, what are we doing this year, Tim? What are you advising?
I mean, we all naturally have our outlooks and things like that and their opinions. I think it's important to know that all these things change. And I mean, you look at the Wall Street firms in 2022 were like, oh, it's going to be a good year. And it was a disaster. And then 2023 is going to be a bad year. And then it was great. Yeah. So you got to take, in fairness.
Like down we thought would be up and then it was up and we thought it was going to be down, right? It was like this.
Rates are going to go up. The market gets killed. And then they
22 ended like pretty bad, right?
Yeah, down 20% in 2022. I think it was 19.7
and then this year is up 24, 22.
23 is over, but yeah, it was 26 with the dividend if you include the dividend.
That's
so
crazy.
The net is pretty, pretty close, but that's a pretty normal cycle, Okay.
When you see a down, you're going up. Is it rare to have a down and a down?
Yes and no. I mean, so I'll flip this. I was looking at some statistics earlier. If you go since 1950, and by the way, a lot of history can go back really far, but look, they didn't even have indoor plumbing. You go all the way back.
Exactly, and times have
changed. But 1950 is kind of an area where, like, after the war, a lot of data kind of in the financial space kind of starts from. Anyways, 1950, I think there were like 25 years where the market had up over 20% for the year, right?
Wow.
And in 85% of them, the next year was positive, right? So the momentum continues. But there was only 2 years where the market was up 20% again. Wow. I actually remember that. I think 98 was one of those years, 98, 99, like the S&P had like some really good back-to-back years. But money moves around. It's funny because as we sort of have these multiple opportunities, with real estate and investments and things, it's all opportunity cost, right? That's kind of why we talk about the 10-year treasury. The 10-year treasury is like the tip of the spear. It says, look, the guaranteed rate on a 10-year bond is 4%. Now you could argue the solvency of the U.S. and all that, but look, that is the safest money on planet Earth.
Yeah.
And so there's your starting point. Like if I get 4% with that, I'm
That's
cool.
That's why a lot of people are money sitting on the sideline, just chilling. But when that comes down, it's got to go somewhere else.
Yeah. And then, you build from there. Bonds, equities, real estate, they all have a risk premium that says, look, I need to get that 4%. I'm taking risk in equities. It's maybe twice that usually. Mm-hmm. And so, people make those decisions. You don't have to put all in one particular thing, but it all boils down to that opportunity cost. So I'm having a lot of conversations around that lately. Hey, Tim, I've got, this cash over here from selling these stock options. What do we do with it? Yes, they do like getting that 5% money market, but inflation now is up a little bit. So that's why we got to invest, right? To keep ahead of taxes and inflation. And then it's like, well, wait a minute. If I need this money next year for Susie's college, like I don't care what the stock market does. I need that in money market, whether it earns a penny or not. So some of that stuff is like time. Give me a time frame and I can tell you kind of.
Yeah, so you're just getting a lot of different scenarios. Are you heavier in cash now? Are you recommending?
Actually, no, surprisingly, because, I put this out and I put a kind of weekly, I wouldn't call it a newsletter, but it's a little bit of a commentary. It's got some behavioral things about the market. It's got some statistics and a bunch of things, but you can get it on our website. But, I think when we had our year-end meetings this year, I'm telling clients, like, people aren't prepared right now for if things go right. If they actually,
I would 100%. It's a very good statement. Like we're all thinking we're on the third year if it's going to be a recession.
Yeah.
The longest, ongoing call for a recession ever, right? Yeah, that's a good statement. Yeah.
And at some point, it's like, okay, whatever.
What if it does go? You're going to miss. You're going to lose. Yeah.
Yeah. So, there's a little bit of opportunity there. When we think about GDP, right, and just simply like that's the U.S. economy. That's the business of the United States. Yep. It's what's a recent number, 21 trillion or whatever, but 23 trillion. But that's the pie. And even the pie grows at 2%. Like it's a big pie.
Yeah.
And that trickles down to companies, right?
Yep.
Now, right now, we're seeing, they call it the Magnificent Seven now, right? Like those stocks are driving the market returns, but they're seeing explosive growth in earnings. The S&P 500, You've got,
Is that a good go-to? A lot of people just put their money in there. It's just been.
well, yeah, I mean, but I was gonna say the S&P earnings, I think for 2023 will be like $220 per share, right? So
Okay.
you take the earnings, a PE multiple, which can change, and you kind of get the price, right? That's how people look at things from a holistic view. Next year's earnings, we could be 245, or those could get adjusted to 250, right? So that the earnings are growing, and if the PE multiple stays the same, well, then the S&P, climbs to that new level.
Okay.
But nobody says what the S&P or what the PE multiple has to be. Now, we've looked historically at ranges, right? 17, 19%.
Mm-hmm.
Then it gets overvalued a little bit, and then it gets lower. But there's a lot of, there's no rules that say it has to be this. So earnings could go up, but the PE multiple could go down, right? Because the price goes down. You could have earnings going down, and yet the stock's going up because the multiples were expanding because interest rates were getting lower. So I don't know. We can geek out on investment things like that. But, I think to the original point, I think people are underinvested, especially, look, if you're looking out at 5-10 years, like it's de minimis, even if we do have a recession. And from when you look at the National Bureau of Economic Statistics or whatever, the recessions get announced a year after they happen, right?
Yeah.
So we'll be out of it.
Yeah.
And it isn't the end of the world. It just means the GDP is declining a little bit. But, if you want a job, it's out there. Now, not everybody, maybe this next generation, they don't want the jobs that are out there.
Yeah.
That's another story. But like if you want to work, you can. So the unemployment is low, or, we have pretty close to full employment.
Yeah.
Interest rates are low. Taxes are low. They're going to change in a couple of years once the Trump tax cuts go away. But there isn't something like the quicksand that people think. There isn't a boogeyman around the corner right now. A lot of things can change. I think the wall of worry around Ukraine, Israel, that stuff, it's already sort of priced into the market.
Yeah, I agree with that. Yeah, just like even we were talking about that. I think today the 10-year Treasury move down in rates is already kind of priced in. They're like that priced based on maybe some rate cuts. Maybe we get the rate cut May, June. That's what we're kind of guesstimating today.
Yeah.
Maybe we'll see a little bit pull back in the 10-year, but it's already priced in. Just like it's funny, Bitcoin ran up to like 45 something. It was priced in and it sold back off because I'm like, that was priced in the ETF getting approved. And people go, oh, it's going to run it past. I'm like, no, it's got up to the pullback and run. Like, so I think you start analyzing these, you start learning the technicalities of this all,
The funny thing about the Bitcoin thing, right? We call that phenomenon buy the rumor, sell the news, right? And you'll see companies' earnings. We're getting fourth quarter earnings now, but they expect good things. The stock goes up and then it gets announced it goes down. You're like, well, wait a minute, it's good news. Well, look at the stock price the last 2 weeks. It's up 20%.
Are earnings coming out this week or next week or?
Well, they're continuous,
Okay.
the wrapping up the fiscal year. And so companies, it starts with the banks and then.
Usually JP Chase, right? Is one of the first.
Yeah.
He's always like the leader. All right. So one things I want to talk about today is another strategy I think people can use that. So a lot of people we deal with, they'll have cash in the bank.
Yeah.
And then they're just like, they use it all up. And then I always, I know the wealthiest people in the world, they have different strategies about this, right? So you just learn from, I always tell people, you just learn from the billionaires, right? I tell people, take an Elon Musk, a Mark Zuckerberg. I said, you notice they don't take a paycheck. It's like, how they afford all this shit. I said, well, because they get a loan against their stock.
Yeah.
And so I think there's a lot of people.
Call it a securitized loan.
Yeah. So I wanted to talk about that because there's people in real estate and it's funny, they'll call me, they're a W-2 person. Mm-hmm. They stack that thing. They got 7 figures and like, hey, I want to start buying real estate. And they're like, shit, I got to sell the stock. I'm going to pay capital gains. I'm like, why would you sell the stock? They're like, what are you talking about? I'm like, don't sell the stock. Just get a loan against it. Like, what? They don't even know it exists, which is kind of funny, right? But they just don't know.
Sure.
So I want to talk about that because I'm not, you can do these for people, obviously. Mm-hmm. I don't really understand all the technicalities. So I'm just going to pick a number and pick a stock, and then you can tell me if I'm wrong or right or how this works. So let's say I work at Google and I've got $3 million in Google, and maybe I want to move some money over to you or do whatever with the money, right? It doesn't matter.
Yep.
Hey, I want to take out $500,000.
Yep.
Then people go, well, how does this work? Do I pay taxes? What's the interest rate? What if the stock goes down? Mm-hmm. Like, is there a call? So can you explain how a loan like this works? Because a lot of people don't even know these exist, but a lot of people don't realize maybe they want to go buy an investment property, start a business, put the money somewhere else. And they don't realize that money can be making money still. You can draw, it could still, can you explain how this works?
Okay, so let me round down. I'll round down to $1 million.
However you want to.
I'll round down to $1 million just so I can do the math.
Well, I did $1 million. I said $1 million. Yeah.
He said $3 million. But
okay,
so you got $1 million in Google stock. And the key thing to understand there is your cost basis. This client probably has a pretty low basis. So
let's just pick a cost basis.
Let's just say 100,000.
Okay, perfect.
Right? So if he was,
they're up 900. They're up 900,000. Which, if you start selling, it's a huge.
Yeah, and if you sold, $500,000 to buy a property, you'd pay a lot of capital gains on that.
It's just capital gains. It's not based on your income, right? It's just,
assuming you've held it for a year, it gets taxed at capital gains.
Under a year, it's ordinary income. You're going to really get hosed. Okay,
yeah,
especially in California.
Yeah, and especially if you're a high earner.
Okay.
That could be 37% plus state, right? 37 federal plus 10 state. But yeah, to your point, you've got this asset there. You can use it. Now, Google's kind of cherry picked because the stock's going up 25, 40, 50%.
Well, that's my point is
lately.
So let's say you get the $1 million and you're like, well, why would I sell this thing's going, right?
Yeah.
Okay.
So you want to be careful. You don't necessarily want the tax tail to wag the dog, right? Like if we're in a situation where it's like, hey, there's a dream house, kids, school district, like buy it, pay some tax. But but if you look at it from the area of how to keep that stock, you can go to Schwab or Fidelity or, Merrill Lynch or any of these financial institutions, and they'll just give you a loan off the value of that portfolio. It really isn't much different than margin. Some people are familiar with margin. Margin is where you borrow against your stocks to buy more stock. Okay.
Oh, okay.
And they, margin rates, have historically been kind of high, like 9%.
That's why you hear that. I got a margin call, meaning the stock went down, you got to pay it. But
because you borrowed so much against it, there isn't enough equity in it to hold that loan. So they say, we got to sell some down. Okay. Now, a securitized loan is very similar. The difference is you can't use that money to buy more stock, right? So you can use it to buy real estate. So there's different terms on that. Now, historically, they were using LIBOR plus a spread.
Now it's SOFR.
Yeah, LIBOR, London Interbank Offer Rate or something. Yeah, and I don't know if LIBOR went away or it just
got replaced.
Yeah, so SOFR
there's
is
a
like
lot of
secure overnight.
Yeah, I don't know why. They just got replaced. That's just show.
Yeah,
and SOFR sitting at, let's say, 500 basis points right now.
Yeah, now it was zero, a year ago.
0.30. Yeah.
But what happens is you've got that rate, which is the cost of capital. Then you've got the financial institutions. I'll just say Schwab. Their
spread margin.
They're big. So it might be SOFR plus 3%.
And guys, just SOFR was like at 30 basis points. So people are getting loans at like 2.5%
for no cost.
Yeah.
There's no charge to do it. They're like, look, if you got the stock, Schwab's happy. You keep the stock there. They're loaning against the margin, making money that way. And as long as you've got the value, right? And the value doesn't dip. Now,
and let me ask you, just back up. So let's stop. So we got $1 million.
Mm-hmm.
You bought it for 100,000 and it went up 900,000. Good for you.
Mm-hmm.
You want to go borrow $350,000. Doesn't matter. And so once you start buying it, there is an interest rate tied to an index. So if it's SOFR plus 3, we're just going to say it's 8%. We might be wrong on that. Do you have to start making a payment on that every month?
No, you don't.
Okay, that's okay.
You don't, as long as you got the equity. Now, stocks.
What do you mean? Can you explain that? As long as you have that equity.
So let's say it's Google. That's a stock. They'll loan you 50% off that. Okay. Right? So $1 million of Google stock, they'll give you a $500,000 loan. Okay. If you had T-bills or treasuries, whether they're 1 year,
80%.
T-bills are 1 year, T-bonds are 1 to 10. So they'll loan you 97% against that.
Whoa.
So $1 million, they give you a $970,000
you're still
loan.
making the 4 or 5%.
Well, in Google, you're making, in a T-bill,
okay.
Good point. In a T-bill, you're making 4% or whatever. Yes. You could borrow $970,000. Now, as long as you have enough equity, and there's certain break points, right? You have to have a certain amount of equity. Once you tap into that, they want.
So when you're not making a payment, how does that work then?
It's accruing.
Okay, so so the $500,000 loan is it's going 5, 10, 5, whatever. It's going up. Okay, cool. You could pay it.
And but remember, there's $1 million asset against it, right? So if anybody gets real nervous, right, you just sell the stock like you would have in the first place. But maybe you got a big bonus in 2024. You don't want to sell the stock in 2024 because you're doubling up on taxes. Okay, so you take the bonus, you take the loan, maybe you deduct the interest, maybe not. But then in 2025, okay, you sell off that Google stock and pay down the loan. I mean, I got a client that did that. He's got, $30 million in Apple stock.
Wow.
He built a, McMansion up in the Bay Area. He had another property, which he couldn't get out of it. So he literally just, in a week, we had that thing set up. And
so let me ask you a question. So, because I'm just like the numbers guy, I'm trying to figure this out for people. So we'll go back. We got $1 million. You borrow 500. The rate's 8%. This Google's doing, Apple, Google, whatever. It's making, let's call it 15%, right? Whatever. So when you average that out, are you really even technically paying a payment if it's like you're
arbitraging there.
You're out earning it, basically.
Yeah, you are. Okay. Now, look, in fairness, like Google, it has a high rate of return.
Shit could come down, yeah.
And what goes up, there's two sides of the coin. But you might have a 20% decline in the stock, but it might happen 50% higher from where it is now. So it's still, You could have said, hey, let's buy Facebook dropped to $100 like it did. Hey, let's put $1 million in, Tim. And you're like, I need a loan against it. And you have $500,000. Next thing you know, you're like, oh, by the way, your $1 million is $3 million because it's up to $300. Yeah.
If you just took the money, you would have never got. So my point to people is you can actually, if you're in real estate or other things, you can leverage your money, keep it working, borrow against it. And depending on how it does, right? If it goes down or up, you honestly could not really technically on paper, you could show you're not really paying for this. And so you're taking that money, maybe investing over here, business, college kids, whatever the heck it is.
You can do whatever you want with the money. You just can't buy stock.
Yeah. You can go buy a house, whatever, or real estate, and you're getting more equity. This could actually, you're just keeping it going. And so I was just explaining that because a lot of people think they got to sell stock and do all this stuff. And I'm like, that's not really
It's a very, very powerful tool that is underutilized, I'd say, in the mainstream. You get up in the high net worth, the 10 million and
very
up
common,
space.
very common.
They just know how to get liquidity, and they know how to leverage things. And leverage doesn't have to be a bad word, right? But it isn't a bad word.
Oh, and then the big benefit is when you take the 500, there's no tax.
That's right.
It's tax-free money.
Yeah, it's a loan.
No,
it's not income.
Yeah.
It's a
so
loan.
I know we said you sell, there's tax, but that's the beauty of it. There's no tax. So if you paid it back, you did investment, you paid it back, you're good. You're even.
Yeah. I mean, I've got clients that they have a portfolio of what we call preferred stocks, right? And some of those might pay 8 to 10%, right? They're getting that interest. Now that is taxable, right? But they're getting 8 to 9, 10% dividends coming out of this thing. Now that rate, because SOFR's gone up, it's almost a wash. But before, they're making 8%, 9% of their money while they're buying another property, and then that's doing its thing, right?
And that's what the comment I was going to make. So guys, this is the crazy thing is, if you go back 2 years, you get the same situation. Instead of the rate 8, it was 2.5. So when this stock's going up, it's literally free money. I mean, it's kind of a no. I was just saying that for anybody that doesn't understand that is really a good, because there is corporate people that come to us and they're W-2 this and they built up the stock and they're kind of like, hey, I've got the stock this and I really want to use some of that money, but my basis, I'm going to get smoked and they're high earners. They're like, but I don't want to sell it. Like I believe in Apple. I don't want to sell that. But I want to take some
of that. A lot
of
those stocks brought them into the dance, right? Made them rich.
Yeah. So they're just trying to, the thing is people are trying to tap into that to do something. Like you said, you could buy a house, you could buy something else, whatever. I mean, the wealthy people in the world, they're buying their houses, cars, planes, whatever with it. That's just what they do. And
they can always unwind it, right? They can always just sell it and pay off the loan the next day. But a lot of times they're generating money from other sources or that new investment that they just made. And they're paying off the loan and they don't have that cash flow crunch. I think, the two different scenarios are if you've got a highly appreciated stock and you're looking to finance something, either a new purchase or a bridge, maybe you're in between and you need a big chunk of change, but you can't just, go to the bank and be like.
I would say it's a very used for a bridge loan. Yeah.
Very good for that.
Yep.
You think about people too that have cash and they've got these mortgages at 2-3%. They're like, hey, I want to pay off my home. I get it, right? But I go, that's pretty cheap money you got on your mortgage. I mean, you could put it in cash and get 5 and you're making the difference. Now, some people want that sleep at night. They don't want any payment. That's fine.
Yeah.
But there's a mathematical version of that says, look, you can actually make money on this by not paying off the loan and getting the interest on the other side. You got to understand the rules of the game, because some of that stuff, if you're not careful, leverage can work.
That's why I think when you do that, having like an advisor like you or somebody that's like, hey, we're going to do this, like get somebody that's like, hey, we'll do this, but you got me covered, right? These things are changing. Hey, and I think too, a lot of people, why they want to do this is you could be at a Google and you're like, hey, we're going into a booming like economy or something. And I know this is going to go up. Like, if I pull and pay tax, I'm going to lose. So
yeah. Plus the opportunity of the, yep, exactly.
What do you,
was that a lender just saying, hey, don't do loans and, look at these things? You're cutting off your nose and spite your face, man.
Because we have people come to us and they're like, hey, I want to buy some investment property and I got this cash. And I'm like, do you have any stocks? Like I do. And they're like, oh, what do you have? They're like, oh, I never thought about that. Because they're like, I'm going to sell stock. I said, do you want it? They go, no, I don't want it, but I don't have a choice. I said, yeah, you do. This is happening. No, I had one guy that didn't know it, and he didn't know, and he used it, and it was the biggest, light bulb moment. He's like, this is crazy.
I know.
Give us some nuggets. You've been doing this 20 years. 25. What are 25?
The gray.
You've been long enough. What are some of the things that you've seen that somebody put money in, whether it's S&P, this and that's just kind of a no-brainer kind of thing people, can do that you've seen that's really done well for you, your clients over your investing career?
Yeah. I got a few thoughts on that, and I got to look behind that curtain. I want to make sure my compliance guy isn't behind. Is he there?
Nope, we're good.
Because you got to be careful what we say.
Yeah.
So
no advice, but just kind of like in general, because everybody says just put your money in S&P, Warren Buffett, and you're going to get 10% over time. And some people go, yeah, but you could have invested in stocks, or
individual stocks.
Yeah, and you crush it. So,
good, better, best, right? I mean, I would argue that the S&P is in that better to best area, right? It's a good starting point, right?
I like it better to best area. Okay, cool. That's how
it
you
is.
Look at it.
Just it's 500 stocks. They represent 500 large companies that are large market cap of the United States.
7 really.
It's 7 of them.
Seven
last
seven
year,
horses are really pulling the sleigh, right? Or whatever you want to call it.
You're going to start seeing people with like tattoos, Ferraris with Mag 7, Magnificent 7. But those Magnificent 7 last year, the S&P was up 26%. Those, if we extend it now to the top 10 stocks, right? Because I don't know if Microsoft's in there, but if you take the top 10 performing stocks in the S&P 500 last year, that accounted, you ready, for 86% of the return of the S&P. Right? So if you think about that, almost over 20%.
What's probably the best stock in there?
Well,
was it
NVIDIA?
Oh, they had a good year.
Yeah, NVIDIA and then Apple and
Okay.
But okay, so you can own, when you think about it, the top 10 stocks, right, accounted for 84% of the return. That means 490 stocks just contributed to 14% of the return, not 14% return, 14% of that 26% return. So it was basically like they generated.
So what was the return S&P? 10% last year?
No, it was 26.
Oh, the S&P was.
Yeah. So I'm saying those.
But when you said you averaged it the year before, it was.
Yeah, down the year before. But look, over 100 years, the market has averaged. You add them all up and divide them by whatever. It goes back a little more than 100 years, but you're going to get that 10% number. Okay. The key is that's the average return. That's not the compound return. And let me explain the difference.
Compound interest, the seventh wonder of the world, or whatever they say.
Well, yeah. But think about it. If you've got, you've heard the story like the average weather in Arizona is 70 degrees, and the average weather in Chicago is 70 degrees, right? One of them's pretty constant, right? Or San Diego, it's constant. The other one's like really hot and really cold. They're both the same average, but they're very different, right? If you took $100, right, and you went into a restaurant, you asked somebody, okay, here's $100. This thing is, and you lose 10% of your money, right? Most people might say, okay, 10% of 100. All right, so I've got $90 left. Say, all right, you're down 10%, you got $90. And then you ask them, well, what do you need to get back to 100? What are they going to say? Most people are going to go, 10%. I'm down 10. I need 10. No, you need 11, right? Because you now need, $10 on 90, $10 on 90 is not 10%. It's, a little more than that. And that number gets bigger and bigger. We call this the volatility gremlins, right? If you lose 50% of your investment, you don't need 50% to get back even. You need 100 to get back even, right? Down 50 takes 100
you're right.
to get back even.
50 is going to get you to 75. Yeah.
So when you look at what we call the compound rate of return, that's the money that you actually get to spend, right? Your money went down and then it went up, but a lot of times it's replacing what was down. That's about 7.1, 7.2. Now that's not a bad number. That is a pure compounded number, right? We call that the CAGR, right? Cumulative growth rate, annualized growth rate. So we were talking about like the different options. The S&P, is going to give you, that return. There's going to be years where it's up, 10, 20%. There's going to be years where it's, 0 to 10. There's going to be some years where it's down 10, down 20. It's all going to kind of average out, right? But remember how we said the top 10 stocks drove a lot of it? 490 didn't do much. Now, I would argue that at some point, some of these things start to perform in that 490 area, right? You could cut off those 490 stocks and ride those 10.
I was wondering
may
too.
or may not do better.
Some people might do that, right?
Some people might do that. Some people might look at, okay, let's cut off the bottom, 200, maybe that are kind of lagging along and they're in sectors or industries that are maybe kind of moving sideways now. So there's different ways to skin the cat, One thing that's come out that I think is really interesting, we've talked about ETFs. There's something out there now that's called a buffered ETF.
Okay. Never heard of it.
And real simply, this is how they work. They have sort of time maturities, right? So every month, January, December, whatever. But they've got, when you invest in them, they track the S&P 500. They track different things, but let's just take one that tracks the S&P 500. They have a ceiling, what we call a cap, right? And let's just say that's 15%. S&P's up, 10%, you're up 10. S&P's up, 15%, you're up 15. S&P's up 20, you're up 15, right? Because you hit that ceiling. Okay, it's not a bad thing. Now you say, well, why would I do that? Why wouldn't I just buy the S&P? Now we go the other way, all right? Now they've got 10% downside protection. I'm making these numbers up here on this one, but like S&P's down 5, the fund's down 0. S&P's down 10, the fund's down 0 because it has 10% protection. Wow. S&P's down 15, you're down 5, right?
Wow. That's pretty huge.
Yeah. And
so like in a 22 situation, it could have been a lot less below.
Yeah.
But in this year, when you would have got more of the upside, but you would have probably done better.
Yeah. And you start to sort of average it out. And the name of the game is not like the highest rate of return per se.
Yeah.
It's consistent returns. But let's say the market did drop 20%. And let's just say you had 10% protection on that, right? Well, what happens? When the let's just say it expires in December, you can sell them in any way. You could sell it the next day if you want, right? But they'll be subject to what the value is. But you get to December, right? You buy it here in January. It's going to mature in December. Market's down 20%. You've got 10% protection on it. You now are getting 90% of your money back in this extreme scenario, and you're able to invest it in a market that's down 20%.
Wow.
Which only happens,
that's crazy.
Periodically.
That's crazy.
So, stocks, they all do different things, but like overall, I advise this to clients, like most of the investments or the different asset classes, they do what they're supposed to do, right? We've got years of data on all this stuff, whether it's real estate or CDs or treasuries or inflation or whatever, right? It's when people are using like the wrong tool for the job, right? If you want to grow your money for retirement, like don't put it in CDs, right?
Yeah.
If you want to save money for a house that you're going to buy next year, don't buy .com stocks, put them,
Yeah.
And so it's using the right tool for the right thing. So, buffered is something I think you're going to start to see a lot more of that prevalent. There's a little bit of education that sort of mainstream needs to kind of figure out how they work, but they're really not that difficult once you just figure that, hey, you get the upside, but not all of it, up to a cap, and there's downside, but not all of it. And it's a nice little balance, and so those have been pretty well received. That's something that we do for our clients.
Well, Tim, I think we're going to wrap up. We'll have to probably do a 2.0 on this, but really, I think we kind of figured out at the, you're at a level of, you're just giving 5-star service to your clients. You're probably looking at tax returns. You're looking at wealth strategy. You're building wealth. You're helping with a lot of stuff. You're meeting with them probably once or twice a year. You're there for phone calls. So really a role like somebody like you, there are others out there. It's really a very hands-on, we want the client to be involved, kind of like this kind of strategy.
Yeah, I mean, I guess if I was
and it works probably better. I mean, I think your clients are probably happy, and nobody's leaving you to go somewhere else, probably because, I mean, that's just, I'm sure people aren't.
The mission is clear, right? People, we understand what the role is. So yeah, I enjoy what I do. I think, to simplify a lot of this stuff, I'm an ideas guy. Yeah. Right. I know a lot about, quite a few things because I've been in this business a while. Believe me, I've got the battle scars. Yeah. But I really like the fact that, you can collaborate with different people across different industries. And you come down to the office, I got a whiteboard, man. We'll whiteboard out, we'll be on it all day if you want. Yeah. Just coming up with ideas, right. And figuring out, what makes sense for you. But I think for the listeners, when they think about getting advice, I mean, I certainly, you want to get what you pay for. You want to know what you pay for the advice, right? If you're working with somebody, understand, like, what am I getting for that? What am I paying? What are my investments costing me? Are you helping me with taxes, or do you need to go somewhere else with that? Are you collaborating with my tax professional or state? Just, ask, I think that is really the big takeaway. And you don't have to be intimidated. I've had people come, I don't know if I have enough. Look, just have a conversation with somebody. You might meet with somebody and maybe they're not a good fit. We certainly do that. Like, hey, look, I think I'd recommend somebody down the road that I know, that I trust. They might be better for this situation. But
yeah, of course, not everybody's going to be right.
If you don't ask for the help, then you'll never know. And I'll finish on this. I met with a colleague today, really successful guy, entrepreneur guy. And he knows a lot about this stuff, taxes, wealth management, all that stuff. And we went through kind of his plan today. It was sort of the plan delivery meeting. He was like, holy shit. Like, I had no idea, because in his bubble, he knew a lot of stuff, and he did know quite a bit. But I'm like, dude, there's a big, world out there of things to cover, and nobody can be an expert in all that stuff, especially if you're in another, you're doing something else, entrepreneurial, whatever. And so it was just we kind of joked about it. I said, I told you, man, like, there is something to this. But
yeah, and clients are coming to you for a lot of maybe, hey, you have a good CPA. What do I do here? So it's like, hey, just call me. Like, like I tell people with real estate, don't bang your head. Just call me. I might be able to advise you, refer you, whatever. Where's the best place people can learn more about you if they want to reach out to you?
Yeah, I mean, like anything, the website's Dyer WM, like wealth management. There's some stuff on there. I've got some things kind of hidden on the site because we do some marketing and funnels and things like that. But I've got a podcast. It's called the Retirement Power Play. So people that are, and if you like hockey, you'll love it because I'm a big hockey guy. You are. I kind of tend to weave some things in there.
You've been taking me to the goals games. Yep.
Yeah, good stuff. Anybody wants to go see live hockey, let me know. Happy to go with you. But yeah, that's a good place, and all my contact information is on there too.
So we always ask one final question. It'll be interesting to see your answer. What is your definition of generational wealth?
Well, I think my definition of generational wealth is financial independence that transcends, multiple generations. Now, unfortunately, statistically, usually after the second generation, it gets kind of wiped out. Yep. But I think the important thing there is, especially one of the things that we talk about with our clients is really getting that next generation trained and involved in this, so that it's not, because this sounds silly, but like, if you dump a lot of money on somebody that's not prepared, they're gonna make dumb decisions. We see it over and over again. Anyways, generational wealth is, it's always empowering to see somebody that built something and then they've created a legacy that provides for other people. And it doesn't just end there. It allows those people to thrive and provide for additional people, So it's a good question. And I guess that's how I define it.
Well, that's it. That's your answer.
Wrap it up, Mike.
It's funny. That answer is, I've gotten I mean, I don't know how many times I've asked it. I've gotten so many different answers. It's funny. Like some people are like, oh, I'm glad you, and some people are like, man, I got to think about that. I stumped them, but it's funny. Like not one answer has really ever been the same. And some people, it's like way different than people think because some it's like not even about money, it's like passing the knowledge.
Well, there's some people that think the world is flat, so you got to take it with a grain of salt.
Yeah.
Not everybody gets it how it works.
Yeah. Well,
this was fun. We'll do it again if.
Thanks for coming in.
Very good.
So guys, reach out to Tim. Honestly, just look, phone call, super cool guy. That's why I had him in here. Just wanted to talk about what you're doing, what you're up to, because I know you're helping people, you're giving hands-on stuff. And if, especially if you're local here or something, but if not, just feel free to reach out. And like we say, some people are calling me to say, can you review this quote I got from somebody, or can you review this proposal or something like that? We review it. And if hey, you're doing good, that guy's taking care of you. Maybe that's what they say is, hey, could you do better? Like, sure. So, sometimes a review of what you're doing with somebody else is important. So
that's good.
Awesome.
All right, buddy.
Okay.
If you're already a real estate investor, you know that aside from cash flow, you also get huge tax benefits by investing in real estate. But are you taking full advantage of all the potential tax benefits? We've been working with Tim Looney at CSSI for a few years now, and he's saved us and our clients hundreds of thousands, if not millions of dollars in taxes doing cost segregation studies on their properties. Let me give you a few examples. We bought a property in 2019. If we had just used straight line depreciation, we would have saved about $18,750 in taxes. But because we did a cost seg, we saved $258,000. That's $239,350 more than standard straight line depreciation in the first year. The other great thing is, if you're classified as a real estate professional, you can apply this to other sources of income like W-2 or 1099 income, and you can also roll over any unused depreciation to future years. If you've owned your properties for a few years already, don't worry, you can still do a cost seg and save big on your taxes. This is not tax advice, so consult your CPA to see if you qualify to take advantage of these benefits. Call or text Tim at 318-469-9861 to get your complimentary property analysis. Once again, that's 318-469-9861. And I'll also include his information in the show notes. You guys don't want to miss out on these tax savings.